We are members of a church that has lasted for over 2,000 years because of the zeal, conviction, and love that many holy men and women had for Christ and His church. Here in Singapore, since Saint Laurent came 200 years ago, many religious, lay missionaries, and priests have followed and laid down their lives in the hope of building up the church so that all of us know of the salvation that our Lord has brought us. We have benefited much from the toil and sacrifice, from the setting up of schools, hospitals, hospices, and homeless shelters, to tending to the spiritual needs of the faithful in Singapore. It is now our duty to build on their efforts and ensure that future generations will always have the light of faith to guide them. Each of us has been given gifts of time, talents, and treasures, not to be used for ourselves, but to be used for this mission. To develop our young men and women through a holistic education, to inspire leaders who will in turn inspire others, to nurture our children into faithful disciples of Jesus, to form and strengthen the faith of Catholics to be better witnesses of the Lord, to echo our faith to those who are searching for Him, to inspire believers to live our faith courageously and lovingly, and to raise up generations of young people for Christ. To support our clergy who have dedicated their lives to minister to us, to contribute to digitization efforts to grow our faith community, to build and maintain places for us to worship in and be molded in His likeness, including the future Catholic Hub. Just like these saints who in their own ways touched the lives of the faithful here in Singapore, we too have the capacity to be conduits of God's grace and to meet the needs of our church. Let us support the work of the large diocese to ensure that the light of the gospel will continue to reach the hearts of many, to widen and deepen the reach of evangelization so that we can be a more vibrant, evangelizing, and missionary church. Guided by the light that we have received in baptism, let us be grateful for the gift of our faith these 200 years. Continue to ignite and shine with faith, and as one body of Christ, build the church today for tomorrow.
I want to turn off the lights so that Good afternoon, everybody. Hello. Can you say hello? Okay, hi. My name is Andrew Chai. I'm actually one of the board of directors for Catholic Foundation, and I want to explain why I'm doing here, and later I'll get you to say something about why you are here. Okay? Yeah, first and foremost, the Catholic Foundation is the fundraising arm of the Catholic Church. But we realize how important it is not only to raise funds for the church, but also to help members or parishioners you work through your financial planning. Okay, so personally, I've spent a few years of my corporate careers teaching one of the largest insurance company in the world, agents, how to do financial planning. So instead of teaching them, right, I might as well teach our fellow Catholics. That's why I'm here. Okay, and then I enrolled the services of Alex, and I'll let him do his own introduction. He is currently the wealth advisory for one of the major banks in Singapore. Right, so today, that's one of the topics we want to cover. Now, I do not want to trivialize, right, that investment is an easy concept to grasp within 45 minutes. And at the end of the session, we'll help you see that there is a need for you to further work with us so that we help you build your retirement bird's nest, right, for the long term, whether it's for your family, your friends, for the young ones. I like to see young people here.
And the other thing is, if you find this beneficial, please spread the word around, because we want to help 370,000 Catholics realize that financing, investment, there's a God's way of doing it, and it can be done properly. Okay? Now, next slide. Oh, the clicker is with me. So why are you here? If you can share with me just one sentence, very short, what attracted you to come to this talk? Anybody? Sorry? The title, thank you very much. The title. Which part, huh? The invest for retirement or the God's way? For me, we thought for a long time and realized actually the scripture has taught us some very valuable lessons in investments. Actually, the concepts can be applied, right? So we're here to share a little bit about that. Okay, anybody else? Anyone with the different answers? Got nothing better to do on Monday afternoon at 5. I don't know. Sorry? Okay. Got better things to do but decided to come anyway, right? Okay, good. Anyone else? Curiosity. Okay. So if the title has intrigued you, it must be something that you might want to look deeper, because that's maybe, perhaps, speculative, daring on me to say, maybe God's way of calling you to be here. Right? Just like God's called us, both of us, even though we're both from ORPS, we've never met.
No, never.
Yeah, but we have, in fact, today's the first day we're meeting physically. But because we both are from ORPS and we have common friends, and somehow it all came together, right? And we're here. And both of us work to make this content, hopefully, something that's useful for you. Okay? Without further ado, let me just hand over to Alex and let him do his own introduction and to take us through the next 45 minutes or so.
Thank you, Andrew. Hello, everybody. My name is Alex. I think Andrew spent most of his time in insurance. My background was actually from computer engineering in one of the local varsity. And back then, banking seems to be the way to go, so I started in banks all the way to now. Basically, I've always been investment advisory in my span of career. So essentially, I help people to reach their finance, to hit their goals within the risk limit that they are comfortable with. Basically, that's about that. Because sometimes when people invest, they forget to realize that they are taking a lot of risk premium just to get what they want. Maybe they're taking a bit more risk to get what they want. You do not need to take so much risk to get the objective. Okay? But today's talk is mainly to focus on retirement. Okay? Should we, or rather when should we start to focus on our retirement pot? Okay? Before that, we just want to roughly go through the user standard life stage of our life. I think there are 3 major milestone life stages that all of us, if not all, might face during our life. Okay? Changes in income level, changes in spending pattern, and changes in family situation. Okay? And one of the main threat obstacle of this is that you must control your expense over your income. And that's really, really very difficult. Okay? I remember when I started working, my basic was 2006. Okay? And my parents keep telling me, boy, remember to save at least 20%. But I can tell you how much I make, how much I spend. I mean, you have to chase the girl of your life, you need to spend some money, right? No way you can get it so easily. So I met the girl of my life, I got married at 29 with no saving. Then as you got married, you definitely start to spend more, because we do a lot of couple thing together. Then only when we had our first kid, when I was 32, our first kid, then I started to realize, actually we're spending quite a lot, we have no saving. Actually a lot of things are quite expensive. Okay, she was very upset. Back then I couldn't afford a nanny, we couldn't afford a helper, we have no car, we were just staying in a foreign flat. Okay, and we started to really budget our expense, track it down on a monthly spreadsheet. Today we are still doing it. Okay, every month I track our expense just to see where we are. And after 2 years, our kid, really no choice, we bought the second-hand white color Honda Fit. So we were very budgeted. Okay, what I'm trying to say is it's really very difficult to manage expense. It's not easy. Okay, but having said that, if you look at these slides, making a start, That's very important as you start a family. I think nowadays the youngsters call this adulting. I mean, I heard from one of my younger nieces, oh, this adulting. It means that you're having the first thought of having a family, having a first thought of buying a house. So during that time, when you start a family, the expense is definitely, most likely your expense is more than income, unless you are blessed, your parents and Akong help you with some funds. Otherwise, it should be more. During my time, both of us try not to disturb both our parents, so we did everything ourselves. So it was really tough. But after the second kid came, we threw in the towel, we had to get a helper, really very difficult to have 2 kids with no helper. So anyway, as you make a start, you definitely need to have at least 2 to 3 months of emergency fund. This is something I didn't do actually, to be honest. It set me quite a fair back when I have a kid. So technically speaking, I should have planned better if I wanted a kid. And when you have a kid, you probably need to do some insurance, planning for the education fund. Okay, this is something I did. And once your career get better, both husband and wife, the income get better, you tend to realize your expense actually also goes up along with it, because you want a better quality of life. So that would be when your expense is near your income, and that's when you start to think, hey, maybe you want to up our quality of life, maybe you want to get a bigger house, maybe you want to get a better car, etc. But having said that, it's also very important to ensure that you are prepared for it. You need to ensure you have a basic health protection against standard critical illness, hospitality plan, etc. These are some essential things you might have. Then, as your career progresses, by the grace of God, your income should be way much more than your expense. And that's when you can really start to focus on growing your nest egg. And if possible, after retirement, when your time is up, you have some extra money to hand it down so that the next generation wouldn't be so difficult. Okay? I move on next. So before you start on investing, we just want to highlight to some people, what do we expect from CPF life retirement? I know CPF is a very complicated subject. We have a debate between me and Andrew, but I think one of the plan in CPF, we have this thing called a CPF life, whereby you're supposed to get the continuous monthly income from the age of 65 onwards until your time is up. Okay, so at least you know that when you're contributing to CPF or your employer is contributing to CPF, you actually have this. All right? So just to have a quick look, this is based on 2020. So at the basic retirement sum, at age 55, 90,500, you will expect to have $750 every month all the way until your time is up. Okay? Full retirement sum, about $1,400, enhanced retirement sum, about $2,000. Okay? So we have a good look from MOM, from the latest median gross monthly income, across all ages. The latest statistics about 2020 is 4,680. So me and Andrew, we were trying to do some simple mathematics. Average, assuming Joe at 30 years old, with this average income, he should be able to hit the full retirement sum and comfortably expect to receive $1,400 every month from age 65 onwards.
Okay, one of the things that we wanted you to be aware from the get-go, whether you're young or you're currently, depending on your age, is that CPF is a program that cannot be ignored and should not be ignored, right? And it is a program that we need to be able to capitalize on it because it is our social security, if you will, by Singapore standard. But very few people that I have met fully understand it and didn't really use it to their advantage until it's a little bit too late, right? So we're here to tell you that if you have understood it earlier and be able to plan for it and actually contribute some amount of savings into it, whether it's on a voluntary basis or through your employment, you will actually be able to exceed that number over here. These are all calculated from CPF website. But if you come to the program, we'll teach you how to do that, right? So here we've taken a very conservative view based on the median gross salary. So some of you have not worked yet, so you may not be able to relate. Others, you may have exceeded this, this median salary, and that's fine, right? In our next few slides, we'll be able to show you the importance of knowing this and how you can use that as the first foundation for your retirement planning and then supplement it with investments. Okay, and that's going to be the focus of our talk today.
Thank you, Andrew. So before I move on, we just want to know how much do we need to retire. Okay, so back to Joe. He's 30 years old with the average income, no saving, And that was me. When I was 30, I had no saving. Okay? But my income is less than 44,600. Yeah. Anyway, so he aims to retire with 70% retirement income at this point of time. All right? So his income is 4,600, age 30. 70% is about 3,276. He expects to receive 1,004 from CPF Life. All right? That means that he has to budget and plan for this additional income of 1,876. Okay, fair enough. So he has no saving. He expects and hopes to work until 65, and he plans to cover this additional income from 65 to 85, extra 20 years. Okay, from 85 onwards, he knows that he at least still have 1,004. All right. So how much is it required for this additional income from 65 to 85, 20 years? 403,240. This figure is quite easy to get. Basically, 1,876 times 20 years times 12 months, you get this number. So if he is going to save this on a money basis at 0% interest, you probably need to save 1,072 every month.
That means,
years.
That means that if he save with no investment, right? He just put in a bank and assume the bank gives very little interest. That's what this sentence means. Yeah.
And if he were to park the money, that saving for at least 2% interest yield, you need to save about 740. At 4%, it's about 492. So basically, this is the power of compounding. Why you want to start early? Okay. Something that I probably should learn earlier, if I had a chance. So this is the chart. If Joe were to save 1,072 every month for 35 years, at 0% interest is 450,000. At 2% interest yield is 643,000. At 4% is at 947, almost double. In fact, way over double than 450,000 at 0% interest. So this is the power of compounding effect. Okay. So you notice plan change, family situation change, income level increase. So as your income increase along the years, you might want to top up your saving to manage future inflation. Newspapers are all talking about inflation nowadays. Adjustment, or you want to review or speed up your retirement goal. So that is when maybe every 2-3 years, you may want to talk to your spouse. Hey, I think now we got some spare cash. You want to go to LA, Disneyland, or do you think we should keep it for something else? That kind of thing. So you should always try to budget ahead. Something that I feel to do from 26 to 35. Only after I have a kid, everything was budgeted for. But it's difficult. It's a struggle. It's a struggle. Okay, so before we want to focus on the type of asset that we can invest to just get more than 2%.
We will have a Q&A at the end. Is that all right? Thank you.
Yeah. Just a quick show of hand. How many of you invested? I see some young crowd and some mature crowd here. Anyone? What do you invest in? CPF. Nowadays, I read this online youth blog. They always say how to hack CPF. Put your money into CPF to get 1 million by the age of 45 or something like that. So maybe you guys have done that. Yeah. Okay, never mind. Let me go through the slides. So there was a recent survey done by one of the local banks on this on this investment, why people choose not to invest, all right? 66% of people say that they are afraid of making losses. Fair enough. 60% of people felt that they do not know enough to invest, or rather they think that investing is very complicated. In fact, nowadays it's quite easy because of smartphone and everything compared to 10, 20 years ago. Okay. 55% felt that they have no money to invest. But the truth is that they think that they need a lot of money to invest. They think that 5,000, 10,000, 20,000 is not enough to invest. Okay? More than 50% of them felt that they have no time to monitor. Hence, no time to monitor means whatever I invest, you lose money because I have no time to monitor. So there are ways to go around all this. All right? But in that survey, interestingly, over 90% of the same people that done the survey felt that investment is important, but they choose to put it off because of various reasons. No. So the first one is like me, from 26 to 30, living paycheck to paycheck, spending what I have, living like a king. Back then we have budget now, so easy to spend and fly around. Okay. Most people feel that my income is not enough. I earn more later, but they always forget that the expense will also go up. Okay, something to take note of. Okay, some people feel that I always keep reading a newspaper, always people losing money. Maybe this is not for me. Yeah. So anyway, there's many reasons, all right? But what the God want to share through us, through the scriptures, is that they have mentioned a few things. Keep watching the wind, and you never sow. Stare at the clouds, and you never reap. So this tells us that there's never a perfect time to start investing, to be honest. So plow your seeds early because time is in your favor. Okay? Another scripture. Autumn is over, but the idler does not plow. At harvest time, he looks, nothing's there. Again, this tells us that if you do not start to plow, when God calls for harvest, there's nothing there for you. Then you cannot blame God, you know. Yeah, God got to call for harvest now. I can't wait for everyone. So you got to start plowing early. Okay? Of course, any discipline is at times a matter of grief, but later, in those who have undergone it, it bears fruits in peace and uprightness. Okay? Essentially, this is trying to tell you that if you put in hard work, sacrifices, and effort, you should reap double of what you sowed during harvest time. And you'll be in a better position to support your family and also to worship God and to support our other brothers and sisters who are in need. Okay? Next, we want to touch about the type of assets that could help you gear up more than 0% interest. These are all simple stuff. You can Google, you can get it, but I just want to share that with you. So we have classified that into 4 buckets. The first bucket is under cash equivalent. So basically, things in this are highly liquid, not subject to market fluctuation in value. So we have cash saving, something that you all should have. Fixed deposit, but nowadays the interest rate very low, about 0.05. Short-term money market fund, and a very popular Singapore saving bonds. Okay, which is now I think the latest issue is about 10 years, but you can redeem anytime you want. Currently giving a 1.8% per annum on the average yield. Yeah, almost risk-free, unless you think the market will collapse. Okay, the second bucket is under the balance asset. Okay, there's some volatility here. You might lose some, you might make some, but we are focusing on income generation. So we have things like the large cap blue chip stock, like Netlink Trust, Singtel, StarHub, that kind of thing. Good investment, great bond, bonds from the 3 local bank, Temasek rated bond. Yeah. Real estate investment trust. Maybe you're not aware, by the trust mandate, they actually invest into various real estate, and 90% of the income they collect, they must give back to shareholders. Okay? So it's very transparent. And under Singapore law, I think they cannot leverage more than 45% or 40%. So it's quite protected by the government. Third bucket is a higher risk asset. We expect higher volatility here. We will focus on capital growth rather than income. So things like growth stock, small cap stock, non-investment grade bond. Some people call it high yield bonds. Right? Fourth is alternative and others. Okay, some are fairly illiquid, like real estate. Okay, like houses. Sometimes when you need the money you want to sell, you can't sell. Some are not public traded, like the private equity and venture capital. Some have no fundamentals, like the cryptocurrency. Okay? But again, instead of investing into them directly, you can actually invest them indirectly through ETF and funds. So they can use a small sum of money to have the same exposure to a wide range of assets, just to lower your single security concentration risk. Okay, like for example, you want to buy the SIA bond that released at the start of the year, one lot is 250,000. Not many of us have 250,000. And what if SIA is the next high flux? Don't quote me. If that happens, then you might lose 250,000. You know what I mean? So the risk is very high. If you only have like 1 million plus or less. So if you want to go through what's the stock, okay, you often hear people saying equities, stocks, shares, security. They basically mean the same thing. Okay, basically you buy into them. You own a certain percentage of shareholders in that company. Okay, and they can be bought and sell in the market. So what's the main objective of buying a stock? You believe that the company will do well. Hence, you believe that there's capital growth rather than putting your money in the cash saving. And there's dividend. So when the company does well, they'll pay out dividend to you in terms of income. Okay, these are some standard stuff. What's the bond? Bond is also known as fixed income, also known as debt instrument. Essentially, when you buy a bond, you are lending money to the company or government, whereby they issue a bond to you for a fixed rate of return. Okay? They are legalized IOU, and they can be actually traded before maturity. I have to say, you don't have to hold the bond until it matures. In between, you can let go actually. Okay? And upon maturity date, there's a legal obligation for the bond issuer to pay you back. And obviously, if they can't pay you back, it means they defaulted. And that's where you lose all your money. So which is why I normally don't advise people who start investing to put like $250,000 into a single company. You never know. Okay? So the main objective of a bond is to have fixed income, not really for capital growth. And you want to buy companies whereby they have a very strong finance standing. Okay? Preferably is supported by the government. Okay, next, what's the fund? I mentioned before, instead of going directly into stocks and bonds, you might want to go through funds or ETF just to invest them indirectly. And you can use a small sum of money. Easily, minimum is like 500 to 1,000. So ETF is an exchange-traded fund which aims to track an index. Okay? Passive. The mutual fund is the same, but they have this fund manager whose job is to outbid the index. So they are both the same thing, just that one is to track, one is to outbid. Okay? And they both actually invest a pool of money from a large group of investors, including yours, to invest in the range of assets defined by the fund objective. So there's this term called NAV, which is the price of the fund when you buy and sell. And this NAV actually changes daily on the overall fluctuation of the asset on the market value. Okay? So one of the main objectives of buying a fund, an ETF, is that it's highly liquid. I remember during COVID, that day was 18th of March when the market crashed. Some of my customers needed cash, and they even want to let go DBS bond. A DBS bond tumbled down to 82 cents, around 82, 85, and there were no stickers. At that point of time, nobody wanted to buy DBS bond. So he couldn't cash out. But if you have bought funds, you're guaranteed to be able to cash out. The fund manager has the mandate obligation to ensure that it's daily redeemable. Okay? So that's one good thing about fund and ETF. Affordability. It allows you to invest from a small amount to a large exposure to many assets. Like I said, you don't need $250,000 to buy bonds. You can just put 500 or 1,000, invest regularly to have many funds, many that have many bonds in that funds. Okay? You can have a greater diversification, reduce your asset concentration risk, like I mentioned before. So there are three main fund objectives. One is equity fund. They only buy equities for you to have capital gain, no income, naturally higher volatility. Then we have the more conservative one, which is the bond fund. They only buy into bonds, but they buy into like 100, 200, 300 bonds to get income. Typically, they pay you every month. Okay? But let's say if you are young, 20, 30, 40, you might not need income. So you should reinvest back. And that's where the power of compounding will come. Okay? Then you might want to take the income only when you hit 65, when you really need income to retire. Okay? Then you have the balance fund. It's a mix of 50% equity and 50% bond typically, with some income, 3 to 4%, and some capital growth. Okay? Next, we want to share what the scripture advice in finding the balance of what are some of the advice in the Bible that we read to investment. Okay? The first one is time. Okay? So the scripture says, there's a season for everything, a time for every occupation under heaven. Okay? A bit complex, but basically it's trying to say that every event under heaven has a scheduled, appointed time. It is not random. It's all part of God's this grand design plan. Okay? So essentially, time is your friend, so you should plow your seeds early because of this grand plan. Okay? Do not procrastinate. Next is compounding. You notice when you start early, you benefit a lot from compounding. So the scripture says, do not forget, teen sowing means teen reaping. The more you sow, the more you reap. Okay? And this is quite simple to understand. So the earlier you start, earlier on you saw in terms of the charting on the impact of power of compounding. So that will greatly make use of it. So when you start early, you should not get the income out. You should reinvest. If you start early and you get it and you spend the income, then you will not enjoy the compounding effect. Okay, that's something that a lot of people do not realize. Next is be a steady plowder. I learned this from Mr. Andrew. Later he will share with you. So the scripture says the hardworking man is thoughtful, but all is gain, too much haste, and all that comes of it is one. So basically, is do not rush, okay? You can't expect to plant a seed and harvest at the same time, okay? And essentially, every successful investor knows how to control their expense, ensuring that there's surplus of income over your expense to have this positive cash flow so that you can invest regularly. Okay, so that is the main objective of this advice. Next is avoid risky investment. People who long to be rich are prey to temptation. They get trapped in all sorts of foolish and dangerous ambitions, which eventually plunge them into ruin and destruction. Okay, so if you do come across get quick rich temptation that is really too good to be true, then maybe it's really too good to be true to be landed on your hand. No? How random can that be? But if you really come across a very good investment lobang, and you did your homework, you pray about it, you feel comfortable, then I think you should go ahead. But when you come across such a good investment, please remember, do not put all your money there. You must diversify. This is very important. So the scriptures say, share with 7, yes with 8, for you never know what disaster might occur on earth. Okay? So simply said is do not put all your eggs in one basket, because the perfect investment does not exist. And since there's no perfect investment, naturally you need to diversify, right? So out of 10 eggs, maybe one is rotten, but out of the 9 eggs, able to compensate. Okay? Last but not least, through your investment journey, okay, there could be many temptations. We want to remind you to worship God with your wealth, but do not worship your wealth. As you invest, you make money and lose money. But trust me, investing in God will always be positive. Okay, so that's what we want you to do. Next, maybe I share a bit on this avoid risky investment. So when I collected my first 2 bonus, I often hear my friend, hey Alex, FX trading can make money very easily. Really? Yeah, really. So I didn't let my girlfriend know back then with my wife. I went to invest. So I made some money for the first 6 months, but when the market turned, I lost everything. Profit plus principal, I think I left $50 in the IG market. Okay, that was a very long time ago. So back then, even if I did risky investment, but I diversify, I might not have lost all my money. You know what I mean? So that's one of the lessons I felt it makes sense. You really do not know what's going to happen. So navigating your finances. Okay, if you're not started, really advise you to start to allocate 5 to 10% of your income. Okay, as you start your journey, most likely your income is slightly above your expense. Nothing much you can invest, but you have to keep 100% cash. Okay, for emergency funds, some other funds that you have allocated, and also insurance. Okay, to get yourself prepared. Then by God's grace, your finance, your position is getting better. The income increase, but expense also increase, but not so much. And you can start to look into 25% cash, 50% into balanced asset, and 25% into higher risk asset. If you're comfortable, you're not, then maybe you can put 75% on balanced asset. Okay. Then again, by God's grace, if your position increase, as you advance in your career, it should increase. It should get better. So you come to a stage whereby income is much more than your expenses, assuming if you do continue to control your expenses. You read a lot of articles, people making a lot of money, but they end up with the debt. It's all about controlling your expenses. Okay? Once you're used to your atas lifestyle, it's really quite hard to come down. Yeah. So at this point in time, you can allocate 25% of your balance asset into alternative and others. You have spare cash. Maybe you want to buy another real estate. Okay? If you're not comfortable, you can put it back into balance asset for income generation or into a higher risk asset for capital growth. All right? So I think pretty much that sums up what we have done so far. So maybe before I ask any question, I invite Andrew to share with us some of his, he's more mature looking, right? So he has a greater experience than me.
Yeah, I learned through paying my tuition fees. Can you go back to the slide on balance? Okay. Yeah. So I just want to share with you, I understood compounding because I actually work in the insurance company, right? So I know the meaning of compounding. But it's so difficult to really act on it at an early stage, and I get it. Okay? But I was a steady plodder. I didn't know this concept before. right? So I work and I save quite a bit, okay? So over a period of time, I can really attest to what Alex is saying about starting it early, relying on compounding interest, reinvest whatever that comes as a return back because you don't need the money as that, all right? So there is a formula, if you will, in terms of how much you should keep initially, how much you save. You see, we recommended 5 to 10%. Obviously, that's not enough. Huh? That's not enough. That's just a starting point. So what is the percentage that you should be getting to? And at what point in your life? All this has a formula, no? There's a roadmap one. It's not plugged from air. There's logic behind it, okay? So I did the first 3 pretty well, right? For about 20-some years of my life. And I had a little bit of a savings and some extras. But then I didn't know what to do after that. I didn't know how to avoid the risky investments. So to me, all investments appear risky, basically, right? So whichever comes with the higher returns, I go for it, right? So I thought that was tuition fees, right? So, and after a while, I also didn't know how to diversify because I didn't understand the difference between equities in Singapore and equities in US. You know, what is blue chip? What does that mean, right? Fixed deposit never looked interesting because they are 0.05%, right? So there's like nothing, might as well keep the money, at least I feel better than 0.05%. Didn't know what bonds I should get into. And like what Alex said, right, it's $250,000 just to buy into a bond, right? So even if you have $250,000, I just couldn't part with some of the money, not to mention putting all the eggs in one basket. So although the theory of diversification is in here, the act is extremely difficult. Without the right guidance, without the right support group, and the community that will be able to help you. And you don't know who to listen to. And then it's always flavor of the month. So crypto flavor, right? Oh, okay, buy this flavor. So it is messy. It's not a proper road path that is guided by God. Okay? And then it depends on who you speak to, right? If you spoke to the person that just want to do the deal with you, you end up parting with your money. My parents lost a lot of money because they tried to invest without the proper, advice, okay? So I did well in some, and I did really, really poorly in others. So I've lost quite a bit of money and decided when this opportunity came, we need to help not just ourselves, but we need to help our fellow Catholics. Because I'm not the only one, right, I'm sure. So that's one of the reasons why we started putting together a program, okay? Click on the slides. I just want to share with you, next one, I think. Yeah, I just want to share with you what we're going to do, and then I'll give you about 10 minutes, 5 to 10 minutes on Q&A, okay? So we came up with a financial stewardship course called God, Money, and Me, right? What's not covered today, but was covered in other aspects over this festival talks is it your money or God's money, right? And how do you earn that through work, and how do you get out of debt, right? So we didn't cover it here. So getting out of debt is important, right? We look at the income and expenses. But we want you to consider registering now for the first pilot from February to March. It's a 5-week sessions, right? Because every week we will be covering certain topics like what we've covered today, but in a lot more detail, with a lot more structure, and also a lot more formulas. So we'll tell you, okay, if you did this, how do you track your income, and how do you know how much you are exactly spending? Okay, so that you, at the end of it, you are very, very clear whether you're going to be hitting the target or not. Okay, and then the presentations will be for content expert. Okay, I'm one of the insurance part expert because I used to be teaching people how to sell insurance. But we also got people who are in the debt expert. We also have folks who are in investment and work in banks, right? And they will be there to help you see and understand. And all the homework that you have done, I don't want to promise you is go in, sit down. There's some amount of activity you need to do. All of that is confidential. Nobody pries into your personal income. You will know from the exercise that you do, that's strictly your own, right? You do not need to share. Okay, next.
No,
Oh, that's it?
That's it.
Oh, okay.
Back to Q&A.
So, any questions? Just now that lady, you put up your hand.
Yeah, the Joe example, right? Sorry, I hit the slide.
Is there a mic we can...
The very first few slides. Like there was this thing that, if he continued to earn 4,000 plus for the next 30 years, he has the minimum sum required, right?
Yes.
Does that take into consideration that the minimum sum will continue to increase the next 30 years of Joe's life? The
No.
previous one?
No, just based on this.
Just as of now.
Yes.
But you are right, you're spot on, huh? Because the minimum sum, the CPF minimum retirement sum does increase. Okay? The good news is, and in part of the course, we will cover how do you manage that increase? How do you adjust for inflation? What can you do to make sure that you are on track so that you do hit the minimum sum? And then work backwards how much you will get from a retirement standpoint. And then there will be a gap, right? If there is a gap. That gap is where the investment comes in, to plug the gap. So that together with this, you will be able to hit that required retirement lifestyle that you want. Totally based on your decision, totally based on your income, right? And then we can take a very conservative calculation and say, okay, what if you don't make that much, right? What if you didn't invest? Can savings, for example, can savings alone get you there? We have an answer for it. Yes, the answer is yes. Savings alone without investment can get you there. Yeah, but what is that percentage? And we want to cover that. I don't want you to walk away from today thinking, I got that, it's going to reach. What if it didn't? Because there are certain assumptions that need to be made. Does that answer your question?
I think I read somewhere that if you do not hit the minimum sum, you can actually pledge your current HDB on that to draw that. Yeah, it's a bit complicated, so we are not covering that here today.
Yes.
Is the CPF life retirement payout, is it an auto, like opt-in thing, or we have to opt-in?
Okay, the question is, the CPF life, is it an auto opt-in or we have to do something? It is an auto opt-in. By 55, you have to hit a certain minimum, all right? But there is something called an enhanced, you see that? Enhanced retirement sum. Okay, that the certain minimum, like 181 here, is the minimum you need to hit if your salary was based on 4,680.
You should be able to hit it.
And at age 55. That's the target you need to hit minimum to get about 1,390 to 1,490, right? But there's an enhanced retirement sum, which you hit about 271, you get about 2,000 to 2,001 per month, If God calls you back early, what happens with this amount? It's paid back to your family. But if God gives you the grace to live to 150 years, all right, the government will curse because they have to keep paying you. They have to keep paying you this amount until God calls you, yeah? Yeah.
The money that has been accumulated in our CPF.
Yes, in your special account. Yes,
Yes.
in your special account.
This is the one that you can opt out of to receive the payout to let it just accumulate in the CPF further, right?
No, the OA, the ordinary account, is the one that you can withdraw. The SA is the one that the government will force you that you cannot opt out, the certain minimum. Anything above the SA, you can withdraw at 55.
No, there are two types. Either you choose a perpetual monthly payout, or
One
you
lump
get
sum.
more, but a shorter tenure. So maybe if you think, I might only live for 10 years, so maybe you choose that one. Or you think you will live longer, maybe you want to choose the perpetual one. Yeah.
Being Catholic, we ask you to choose the perpetual one.
So you do not know when God will call you.
I don't know when go.
Okay.
Yes.
More so of like investing principles. So just now you mentioned something about FX.
Yes.
I was thinking about investments such as commodities that are more risky, but in themselves they're not bad. So because for commodities you're just trading basically wheat, salt. So my question is, are there any specific principles that you use to weigh whether the investment is really in line with God's principles and in line with Scripture?
I think it really depends on what you want to invest and what you're comfortable with. But end of the day, I think commodities is also acceptable. Yeah, definitely.
But do you have any set principles?
There are principles about there are principles set in the scripture about what you should not invest in, but didn't say what you should invest in.
Yeah.
There are principles set in the scriptures or concepts and Catholic social teaching that says that these are the investments you should avoid, such as putting money in a company that operates tobacco, alcohol,
correct.
Casino, right? Yeah, I know it's a bit hard if you are going into a fund and they may have spread that, but that is at least what you need to be aware of. Yeah.
But following the line of extension, right? Because if let's say we are investing in things like ETFs,
yes,
and ETFs they go on an index, right? And they might be investing in things that are not very they're not aligned.
So actually there are some ETF that are classified as ESG. So they claim that they are ESG certified, so they do not get involved in all these nasty stuff like tobacco, gambling, and such. There are also funds. There are also like some funds that invest only into ESG company that does good. So they do invest in these bonds. Yeah. Nowadays, it's getting more and more popular.
Now our time's up, but we welcome you to sign up for the course. On your way out, there will be a bag that have details of what are the other topics that is covered at the course that is not shown up here. Okay, so please take one of the bags on your way out, and encourage your friends and your parishioners to sign. All right. There's one question: is there a fee? No. Right. As with God's beautiful gift to everybody, it's always free. So we're sharing our knowledge. So please actively promote this so that we can have a successful pilot, and then it will roll out across all dioceses across the Catholic Church. It will be held, the first and the last session is physical at the Catholic Center at Waterloo Street. And in between will be physical sessions in homes, kind of like a marriage preparation course, right? Yeah, so that there will be sharing and so there's presentation, but there's also facilitators sharing and participants workshop. Okay, that's where. When? You have to sign up as early as you can because we have limited space, and the duration of the course is 5 weeks from February 26 to March 26. The exact time has not been, it could be on a weekend afternoon. Okay? Definitely not weekday lah. Okay, so let me repeat that. There are 5 weeks. The first session and the last session are presentation style like this, right? Where certain important concepts of church social teaching will be shared, right? What to avoid, what you can consider. Certain concepts will be covered, like, is it your money? Is it God's money? What do we do with that money? What is work? Why are you struggling at work? All these concepts, right? Because work generates income, right? So that's type. And then session 2, 3, and 4 will be covering topics such as how do you get out of debt, right? How do you make investments? That will be a lot more detailed than this. How do we look at a CPF calculation? How do we come up with a strategy, right? And let's see, Okay, so debt, investments, and income and expenditure. Okay, so these are some of the topics that will be done in the home session, where it is in like a private settings at home. So there'll be a smaller cell group. So session 2, 3, and 4 are private sessions. Everything is done in person unless the government requires us to do online. Then it will be done online. Right now, our plan is to do it in person. It's more personable, right? Very small, maybe 5, or 10 maximum. Okay?
Okay.
Thank you very much. Chris is at the
coming.
corner. On your way out, please take one of the bags that has information of the course. Thank you very much.